The ledger accounts or an account has the format of a capital T. So we are going to use this simplified format, capital T format, whereby the left-hand side we have said is the debit DR, the right-hand side is the credit, normally abbreviated as the CR. That is the ledger account. That is the ledger account. And then at the center here, we are going to have the name of the account. Every account, it must have a name. Either it is a capital account, it is the cash account, it is the XYZ limited account, it is the furniture account, purchases account, and so on and so forth. So it must have the name, which is normally written at the center there. Then the left-hand side is the DR, the right-hand side is the CR. And remember, as we record here, we must always ensure that we have captured the date when the transaction took place. We have the column for the details, which we normally use to record the name of the other account that is affected by the same transaction. Remember, we have said in every business transaction, two accounts are affected. So you must write the name of the other account that is affected by the same. Maybe we have sold goods by cash. So you must say cash has been received, then we have done the sale. So we are going to have the sales account and the cash account being affected. So we must record those accounts in each other. And then the date, the details, and then we record the amount of the transaction. The same case, date, details, and the amount. Like that. Like that. Like that. But now the most interesting thing is this. How do we know which account to debit and which account to credit? For you to be able to know that, we have what we call the rules of recording transactions in ledger accounts, the rules of recording transactions in ledger accounts. For you to be able to understand that this account, I'll have to debit it, this one, I'm also going to credit it. Because the principle of the dual aspect or the double entry concept says that for every transaction, two accounts are affected. One of them must be debited, the other one must be credited. We cannot debit both of them, we cannot credit both of them. We debit one, we credit the other. Now, how will I know that this is the one to be debited, this is the one to be credited? That one will be possible if you understand these rules that I'm just about to give you. So, generally, we have got the following classification of items in the business. We have talked about the assets. We have talked about capital. We have talked about liabilities. We have talked about, or we have mentioned about expenses. We have mentioned about things to do with revenues. We have others we call drawings. And maybe I'm going to include these ones because they are mostly going to be affected. The sales, purchases, sales returns, purchases returns. Those are the items that you are going to find in the ledger accounts. So, the key thing, assets, at what point do we debit them? At what point do we credit them? I want us to understand these items. At what point do we debit them? At what point do we credit them? So let me start with those which are straightforward. For the drawings, we always debit. What are drawings? Drawings, it is when the owner of the business has taken some items from the business for personal use. Either the owner has taken money from the business to pay personal expenses. Remember, when we talked about the business entity concept, the business and the owner are two completely different parties. The owner's transactions, they cannot be combined with the business transactions and vice versa. So if the owner has taken business resources to pay or for his or her own private use, we normally consider that to be drawings. And drawings will always be debited in the drawings account. So the drawings account will always be debited. Drawings account will always be debited. And this is when the owner has taken business resources for personal use. Like, for example, the owner took 10,000 to pay for his son's school fees. He took 10,000 cash. So we must debit that in drawings account. We must debit that in the drawings account. So drawings is always going to be debited. And that is when the owner has taken business resources for personal use. Sales is always going to be credited. Sales is going to be credited always. And where or when does sales arise? Sales arises on sales account, it is only meant for goods sold. So the key word there is goods. Goods sold, they are normally recorded in sales account. And what are goods? Goods are simply the stock items. Don't mistake goods with fixed assets. When you sell a fixed asset like furniture, that is not a sale. That is not a sale because furnitures were not meant for sale. Sales account is only for goods sold. So when you are told that sold goods worth 5,000, you must record that in sales account. Sold goods worth 15,000 on credit to so and so, that is a sale. As long as it is involving goods. Goods are those items that you have stocked in your business for the purpose of selling. When you sell the building, that is not a sale. That is not a sale. We call it a disposal. That is not a sale. Sales only and specifically deals with goods. And goods are things that you purchased from your supplier. You came and you stocked them in your business. Now you are selling them. So you bought them for the purpose of reselling. Note that. So anytime you sell those goods, you are going to credit the sales account. Anytime you sell goods, be it by cash, be it by check, be it on credit, sales will be credited. Sales will be credited regardless on how those sales have been made. Hi. Let me go here. Purchases. Here, when we are talking about goods, they are going to be recorded in two accounts. One is sales when you are selling them. The other one is purchases when you are buying them. So when you buy stock, you record it in the purchases. When you buy goods, you debit the purchases. When you sell them, you credit sales. When you buy goods, anytime goods are coming in, which is now stock. Stock coming in, debit purchases. Stock being sold, credit sales. So purchases will be debited. This one will be debited, but we have some few cases where purchases can be credited, especially when the drawings on goods is done. Like for example, you bought goods worth 15,000. You debit purchases by 15,000. Then the owner takes like goods valued at 2,000 for personal use. You see now, these goods that were bought 15,000, we debited them in the purchases as 15,000 because they are meant for sale. But the moment the owner has taken them or part of them for personal use, we subtract them from what you had debited the purchases. Purchases had been debited with 15,000, but 2,000 have been taken away. They are no longer in the purchases. So you credit the purchases. So the only point where purchases will be credited, it is when drawings have been made in form of goods, because drawings can occur in three ways. Drawings can occur by taking cash from the business, by withdrawing money from the bank, or by taking goods meant for sale. Those are the three ways drawings can happen. You can make drawings of cash. You took cash from the business for personal use. Can be in form of check. Maybe you write a check, you withdraw money from the bank for personal use, and then you take goods for personal use. So if you take cash, it reduces cash. If you take money from the bank, it reduces the bank balance. If you take goods now, it reduces the purchases, because purchases are the goods you bought for sale. If you take part of them for your personal use, now you are reducing what was meant for sale. So purchases will be credited when we have got drawings in goods. When we have drawings in goods, we are going to credit purchases. But now, when you buy them, when we have got goods bought, they are normally debited in the purchases account. In the purchases account. And now here, these two, they are now the opposite of this. Sales is always credited. Sales returns is always debited. Always debited. Purchases, in most cases, is debited, but purchases returns is always credited. Always credited. Purchases returns. What are they? Sales returns are goods that we had sold to our customer, but the customers have returned them back to the business. We sell goods, or I sell goods to you, I will record them as sales, because I've sold them. But now, because of one reason or the other, you return part of those goods back to the business. Now, I'm going to record them as sales returns. Goods once sold, but they have been returned back. So, sales returns, it is for goods that have been returned, but that had originally been sold. Purchases, it is when we buy goods from the suppliers. Then they become purchases returns when we return them back. We buy goods worth 5,000, but now upon investigating, we find that maybe goods valued at 1,000 are not as per our specification. We return them. So that 1,000 of goods that we have returned back to the suppliers, they become our purchases returns. We normally credit the purchases returns with that value of goods that we have returned. Then let me now go to assets. Assets, we say they are the resources the business owns. What is ours? What we have acquired and we know it is ours. So for assets, we normally debit them anytime we are increasing them in the business. Anytime they are increasing in the business. And they will be increasing in the business when they are being received or being acquired. Like, for example, if you bought a motor vehicle, obviously to the business, we are going to experience additional motor vehicles. Motor vehicles are increasing in the business. So anytime an asset in the business is increasing, and they are going to be increasing in the business because they are being received into the business, either we are buying them or we are receiving them. So anytime we debit them. So we debit them when there is an increase, when they are being received, when they are being received in the business. And then we credit when there is a decrease. This is when they are leaving. When leaving the business, either we are selling them or they are no longer being used in the business. They are decreasing. We normally credit them. Capital, it is the opposite. Anytime it is increasing, it is normally increasing when we are starting the business. When we start the business, capital will be increasing because the business did not operate initially because there was no capital. So once capital has been pumped into the business now becomes operational. So it increases. And anytime you take money from the business for personal use, it reduces capital. And when it decreases, you debit. The same case applies with liabilities. Increase in liability, credit. Decrease, you debit. When will liabilities increase? When you are buying something on credit. Anytime you are borrowing or acquiring something on credit, you are creating a liability. You are creating a debt. But remember, you cannot create a debt without receiving something. When a liability is created, there is an asset that is received. Like, for example, you borrow 50,000 in cash. So you have created a liability of 50,000, you have received 50,000. So cash is an asset, is increasing by 50,000. The 50,000 that you have borrowed, maybe it is from Equity Bank, then you have a liability for Equity, 50,000. So anytime a liability is increasing, there is another asset that is also increasing by the same value. When you buy, like, for example, goods of 5,000 on credit from ABC, you create a liability with ABC, but you have increased your inventory by the same amount. So a liability will come with a counter effect, the increase in the asset. You cannot increase a liability and there is nothing that you have received. Obviously, when there is a debt, there is something that you have received of the same value. So an asset will be increasing by the same value, whereas a liability will also be increasing by the same value. So increase in liability will automatically translate to increase in asset. Expenses, these are always debited. Expenses are the operational costs. You pay for rent, you pay for insurance, you pay for salaries, you pay for repairs. Those are now the expenses. Actually, we normally say any amount of money that you spend apart from on acquiring a fixed asset or buying goods, the others, they are normally considered to be expenses. So expenses, they are normally debited. They are normally debited. They are normally debited anytime we pay them. Revenues, credited. Revenues are sources of income. Actually, sales is among them. When you sell, you credit because that is a source of income. We also have things like the discount received is a revenue. The rent received is a revenue. Anywhere from which we can get money into the business, it is normally considered as a revenue. It's considered as a revenue. We normally credit them. So this is normally, or this is the outline, how we normally deal with the transaction. I want us only to do a question, one question only, so that you can digest that, and then Mr. Ezra will take you through in Mr. Ezra will take you through more on Thursday morning. Just a minute. Just a minute. Look at the questions that I shared. Question 1 says that prepare asset, liability, and capital accounts for Michael, who had the following transaction for the month of January 2023. So we are given now the transaction. Anything that is involving money is a transaction. So we are supposed to enter them into their respective ledger accounts involving assets, liabilities, and capital. This is the first statement. Started business by depositing 500,000 in the bank. We have said, and I repeat, the amount of money that is used to start the business, contributed by the owner or the owners, we normally call it capital. Anytime the business is starting, there must be capital being deposited into the business. And therefore, we must have capital account here. Anytime a business is starting, we must have capital being introduced. So the amount of money to start the business is capital. And this capital is deposited in the bank. So let us start. Two things are involved here, capital and bank. Money is being introduced and it has been deposited into the business bank account. Let us have them. Being prompted again here, we are going to be interrupted after 10 minutes. Kindly bear with me. This is now how we are going to record it. Anytime capital is introduced into the business, capital is increasing. The business did not have capital. That's why it was not in existence. Now that the owner has pumped in 500,000, we credit capital, yes, we debit bank. Thank you, Johnson. That is very correct. The asset bank is increasing. Increase in asset, you debit because the owner has deposited money into the business bank account. So the business bank account had no money. So it has received 500,000 from the owner of the business, and bank account is now, because it is a bank account for the business, so the bank balance for the business will be increasing. That is increase in asset, debit. Then increase in capital, you credit, so that we observe actually the double entry. So we shall come here and say 20x3, January 1, that capital is in the bank. I've deposited it in the bank, 500,000. You write the name of the other account that has been affected by the same transaction. This transaction has affected capital and bank. So in the capital account, you write bank because it has affected capital and bank. Then when you come now to bank, it is going to be on the debit side, 20x3, January 1, right here, capital, 500,000. That is the dual aspect, double entry. We have recorded this transaction in two ledger accounts. One has been debited, CR account, the other one has been credited into the CR account. The key thing you note, when you are in capital, you write the name of the other account, which is bank. When you are in the bank account, you debit, but here you write or you use the name of the other account, which is capital. That transaction is recorded. It has been recorded very well. And by observing the double entry. Number 2, purchase a motor vehicle paying by check, 120,000. Here, you need to be very careful. What did we buy? We bought a motor vehicle. We did not buy goods. We did not buy goods. If they were goods, we could have entered them in purchases account. Now that they are not goods, it is a motor vehicle, and we are not dealing with the business of buying and selling motor vehicles. So motor vehicle is a fixed asset, which should be recorded in its own account. So we are going to have motor vehicle account. This is an asset being bought. You credit bank. You credit bank, credit motor vehicle. No, we cannot have two credit entries. The rule is there must be one debit. So in this case, anytime you are buying something, you debit what you are buying. You debit what you are buying. Debit, yes, the motor vehicle. Debit what you are buying, the motor vehicle. Debit the motor vehicle. So you come here, 20x3, this is January 1st. We bought motor vehicle using by check. So the check will reduce the money in the bank. So it is going to affect the bank account, 120,000. Motor vehicle, it is going to increase. That's why we are debiting motor vehicle account, because it's a motor vehicle coming in. So the motor vehicle will be increasing. Increasing asset, you record them on the DR side. And on the same date, the money in the bank, remember we don't have check account. We don't have check account. The check will be affecting the bank. So in the same date, the money that we had in the bank, 500,000, will be reducing by 120,000 because we are using it to pay for the motor vehicle. Decrease in asset, we credit money out. So you'll come here and say 20x3, this is January 1, motor vehicle. You would credit bank because it is decreasing. Asset, when they decrease, you credit them. You credit and then you say, it has reduced because we have used it to pay for the motor vehicle. Motor vehicles have increased and we have bought them using money in the bank. That is what it means. The third transaction, this one was on second, not first. On fifth, purchase fixtures and fittings, 40,000 on credit from ABC Limited. Fixtures and fittings are also fixed assets. When you buy them, you debit what you have bought. Then you credit how you bought them. You credit how you bought them. Debit what you have bought. Here, you open an account for fixtures and fittings. Yes. What you need to remember, all the fixed assets will have their own account. We don't have a common account for all of them. We normally maintain different accounts for each fixed asset. We have motor vehicle account, buildings account, fixtures account, computer account, every fixed asset by its own account. So we bought fixtures and fittings, we debit fixtures and fittings. So we shall come here, 20x3, this is January 5th. How did we buy them? We bought them on credit. If it is on credit, you write the name of the supplier. Who supplied these fixtures and fittings to us? It is ABC Limited. Right here, ABC Limited, 40,000. Then we have created now a liability. Any person from whom we have acquired something on credit is a liability to us. So open an account for ABC Limited. This is now what we call the creditor. Now you credit this. This is increase in liability, which should be credited. So right here, 20x3, this is January 5th. What did we buy? Fixtures and fittings of 40,000. Always there must be debit and credit. Debit what you have acquired, you credit how you acquired it. You credit the account that actually facilitated that acquisition, if it is on credit. We go to the fourth transaction, purchased another motor vehicle. Purchased another motor vehicle. Remember, we already have a motor vehicle account. We are purchasing another one. So we debit anytime an asset is bought, debit what is being bought. This is on 8. How did we buy? On credit. So we write here the supplier, who is XYZ Limited. And that motor vehicle was worth 80,000. So we have another creditor. We have another creditor by the name XYZ. So open XYZ Limited. This is a liability. We owe the supplier, we credit. Anytime a supplier has supplied something on credit, credit is all her account. So you write here 20x3. This is January 8th. We bought a motor vehicle from that supplier of 80,000, or we owe that supplier 80,000 as a result of credit purchase of motor vehicle. On 12th, we withdrew 10,000 from the bank and put it into cash. So already we have the bank account, but we don't have the cash account. Money is taken from the bank and